The precise moment of entering a trade can often dictate its ultimate success or failure, representing a critical juncture where capital is committed and potential profits or losses are determined. Many aspiring traders focus intensely on finding the perfect strategy, yet overlook the fundamental importance of timing their entry with pinpoint accuracy. Without a disciplined approach to identifying optimal entry points, even the most promising analysis can lead to frustrating losses. Today we delve into the timeless wisdom of one of history's most legendary traders, Jesse Livermore, to uncover his 5 indispensable steps for achieving an ideal trade entry. These principles, forged in the crucible of early 20th century markets, remain remarkably relevant and possess the power to fundamentally transform your trading methodology, guiding you towards more consistent and profitable outcomes. The first crucial step in Jesse Livermore's methodical approach to market engagement involves a comprehensive assessment of the overall market trend. This foundational principle dictates that a trader must always operate in harmony with the prevailing direction of the broader market, never attempting to fight its powerful current. Livermore consistently emphasized that significant financial gains are realized by aligning one's actions with the dominant market flow, rather than expending futile energy in opposition to it. Ignoring the overarching trend is akin to sailing against a strong wind, making progress incredibly difficult and often leading to exhaustion and failure. To effectively implement this step, a trader must diligently diagnose the fundamental health of the market, which involves a careful examination of price action across major indices and leading stocks. In a bullish trend, the market consistently forms higher highs and higher lows, signaling sustained buying pressure and underlying strength. Conversely, a bearish trend is characterized by a series of lower lows and lower highs, indicating persistent selling pressure and a weakening market structure. This diagnostic process is not about predicting the future, but rather about objectively interpreting the market's current narrative as told by its price movements. Livermore's profound insight was that the general market trend acts as the tide upon which all individual stocks float. Even the most fundamentally sound company can struggle to advance if the broader market is in a decline, just as a weaker company might experience unexpected gains during a powerful bull run. Therefore, before considering any specific stock, a trader must first establish the market's primary direction with absolute clarity. This initial filter serves as a protective measure, preventing premature entries into trades that are statistically less likely to succeed against the prevailing market forces. If, after thorough analysis, the general market fails to exhibit a clear, unambiguous bullish or bearish trend, Livermore's advice was unequivocal. The most intelligent course of action is complete inaction. This seemingly simple directive is perhaps one of the most difficult for many traders to embrace, as the human tendency is often to feel compelled to constantly participate. However, Livermore understood that capital preservation is paramount, and periods of market uncertainty or sideways consolidation offer poor risk-reward opportunities. Exercising patience and waiting for clarity is not merely a passive act. It is an active, disciplined decision that safeguards capital for truly opportune moments. The discipline to remain on the sidelines during indecisive market periods prevents unnecessary losses and conserves mental and financial capital for when the market finally reveals its hand. This approach underscores a core tenet of professional trading. Sometimes the best trade is no trade at all. By mastering the art of waiting, a trader develops the foresight to engage only when the probabilities are most heavily stacked in their favor, a lesson directly from the pages of Jesse Livermore's own trading experiences. His unwavering commitment to trading with the trend was a cornerstone of his legendary success, proving that understanding the bigger picture is always the first logical step. Moving beyond the general market trend, Jesse Livermore's second pivotal step involves the identification of leading industries or groups within the market. This refined approach recognizes that even during robust market trends, not all sectors or individual stocks participate equally in the upward or downward movement. Livermore keenly observed that significant price movements and the most substantial gains tend to concentrate within a select few leading industries, which he metaphorically referred to as the generals of the market army. These are the sectors that exhibit the greatest strength and momentum, often driving the broader market's direction. Understanding this concentration of power is critical because it directs a trader's focus towards areas with the highest potential for outsized returns. Instead of scattering attention across the entire market, a disciplined trader narrows their scope to these standout groups. For instance, in a bullish market, while the overall index might be rising, certain sectors like technology or healthcare might be vastly outperforming others, showing sustained strength and attracting significant capital flows. These are the groups where the smart money is actively accumulating positions, indicating a strong underlying narrative and future growth prospects. Livermore's methodology emphasized that these leading groups are not merely performing well, they are actively dictating the pace and direction of the market's advance. They are the engine, not just a passenger. Identifying them requires more than a cursory glance. It demands a systematic process of comparing the relative strength of different sectors. This involves observing which industries are consistently forming new highs, demonstrating resilience during market pullbacks, and attracting higher trading volumes compared to their peers. Such diligent analysis helps filter out weaker sectors, regardless of the overall market's direction. The practical implication of this step is that a trader should concentrate their research and capital primarily within these identified leading industries. There is little profit in exploring laggard sectors, even if the overall market is strong, as their potential for significant upward movement is inherently limited. By focusing on the sectors that are clearly leading the charge, a trader positions themselves to capitalize on the most dynamic and powerful trends available in the market at any given time. This strategic narrowing of focus is a hallmark of professional trading, distinguishing it from the often scattered approach of amateurs. This step also serves as a critical filter, allowing the trader to move from the broad market view to a more refined segment. It ensures that the subsequent selection of individual stocks is made from a pool of candidates that already possess inherent sectoral strength. Without this intermediate step, a trader might inadvertently pick a strong stock from a weak sector, thereby diminishing its potential and increasing the risk of underperformance. Livermore's systematic progression from general market to leading group highlights his meticulous top-down analytical framework. Before we delve deeper into the intricate world of stock selection, it is paramount to equip ourselves with every possible advantage. Just as Jesse Livermore meticulously studied market cycles, another legendary figure, Richard Wyckoff, developed a profound methodology for understanding the accumulation and distribution phases that precede major price movements. If you are serious about mastering the art of market analysis and wish to gain an unparalleled understanding of supply and demand dynamics, then the Richard Wyckoff Trading Methods channel is an indispensable resource. It offers deep dives into Wyckoff's principles, providing visual examples and practical applications that complement Livermore's insights into market structure and trend identification. By learning to recognize these underlying forces, you can significantly enhance your ability to identify high-probability trade setups and avoid common pitfalls. Do not miss out on this opportunity to elevate your market intelligence. Subscribe to the Richard Wyckoff Trading Methods channel today and unlock a new dimension in your trading analysis. Having successfully identified the overall market trend and the most robust leading industries, Jesse Livermore's third step narrows the focus even further, selecting the single strongest stock within that identified leading industry. This is where the rubber meets the road, transforming broad market observations into actionable trade candidates. Livermore's unwavering principle here was to concentrate exclusively on the actual, observable behavior of the stock itself, completely disregarding opinions, rumors, or even news headlines that could cloud objective judgment. The market's voice, expressed through price and volume, is the only voice that truly matters. Livermore vehemently cautioned against the common amateur mistake of purchasing weak or lagging stocks within a strong sector, hoping that they would eventually catch up to the leaders. This strategy, driven by a desire for a bargain, almost invariably leads to disappointment and financial losses. Instead, he advocated for buying demonstrated, proven strength. An analogy often used is that of a horse race. You bet on the horse that is already leading, not the one trailing in the hope it will miraculously accelerate. The market rewards strength, not wishful thinking. An individual stock leader, according to Livermore, possesses several distinctive characteristics. It is the stock that moves first and with the greatest conviction when the sector begins its ascent. It consistently demonstrates the largest percentage gains over a sustained period, clearly outperforming its peers within the same industry. Crucially, it also exhibits high trading volume, indicating strong institutional interest and liquidity, which supports its upward trajectory. This stock acts right, meaning it absorbs profit-taking and minor pullbacks with relative ease, quickly resuming its upward trend without significant structural damage. To identify such a leader, a trader must engage in meticulous comparative analysis within the chosen leading industry. This involves scrutinizing daily and weekly charts, comparing price performance, volume patterns, and the ability of each stock to hold its gains. A true leader will often show clear breakouts from consolidation patterns backed by surging volume, indicating strong demand. It is not enough for a stock to simply be part of a strong sector. It must be the undisputed frontrunner, showing clear relative strength against its rivals. This rigorous selection process ensures that capital is deployed into assets with the highest probability of continued upward momentum. By focusing on these proven leaders, a trader minimizes the risk associated with underperforming stocks and maximizes their exposure to the most dynamic elements of the market. Livermore's emphasis on buying strength, not weakness, is a cornerstone of his success and a powerful lesson for anyone seeking to master market speculation. The objective is to ride the strongest wave, not to try and create one. The fourth step in Jesse Livermore's meticulously crafted trading process is perhaps the most critical for precise timing, patiently awaiting the key or pivotal point and crucially demanding price confirmation before entering any trade. This step directly addresses one of the most common and costly mistakes in trading: being correct about the direction of a stock's future movement, but entering the position too early. Livermore famously stated that being right too soon is financially indistinguishable from being wrong, as both scenarios lead to losses and frustration. The essence of this principle is that a trader must exercise supreme patience, waiting until the market itself provides an undeniable signal that the stock is ready for a significant move. This confirmation must come from the market's own behavior, not from a trader's personal forecasts, hopes, or subjective interpretations. Relying on predictions, no matter how well researched, can lead to premature entries, where the stock might consolidate further, pull back, or even reverse, eroding capital and testing a trader's emotional resilience. The market will tell you when it is ready. Your job is simply to listen and act accordingly. A key or pivotal point frequently manifests as a decisive breakout of the stock to a new high, typically after a period of consolidation, base building, or sideways movement. This breakout is not merely a slight uptick in price. It must be a clear, unambiguous move above a previously established resistance level, often accompanied by a significant and noticeable increase in trading volume. The surge in volume acts as a powerful confirmation, indicating that institutional money is actively entering the stock, providing the necessary fuel for a sustained upward trend. Without this volume confirmation, a price breakout can often be a false breakout, a trap for impatient traders. This step underscores the importance of objective, rule-based entry criteria. A trader should have a predefined price level or pattern that, when triggered, signals the optimal moment for entry. This removes emotional bias and guesswork from the decision-making process. Waiting for the price to unequivocally confirm your judgment before committing capital is a disciplined approach that significantly reduces the risk of entering a trade at an unfavorable moment. It is about letting the market lead you rather than trying to lead the market. Livermore's insistence on waiting for the pivotal point in price confirmation highlights his deep understanding of market psychology. He recognized that the market moves in phases, and patience is rewarded when one waits for the definitive signal that a new phase of upward movement has begun. This disciplined waiting prevents costly chopping in sideways markets and ensures that when a trade is initiated, it has the highest probability of immediately moving in the desired direction. The market always confirms its intentions. The skilled trader simply waits for that confirmation. The fifth and final step in Jesse Livermore's sophisticated trading methodology involves a strategic, gradual entry into a position, often referred to as pyramiding, combined with an unwavering commitment to emotional readiness. This phase distinguishes the seasoned professional from the amateur, who typically commits their entire capital in one go, often at the first sign of what they perceive to be an opportunity. Livermore, however, approached position entry with the precision and caution of a general deploying troops, sending in a small, initial reconnaissance unit, what he termed a probe. The fundamental rule of the probe is elegantly simple, yet profoundly powerful. This initial small position must almost immediately show a profit. This immediate positive movement serves as the ultimate undeniable confirmation of the entire preceding analysis. It signifies that the market agrees with your assessment of the general trend, the leading industry, the specific leader stock, and, most importantly, the pivotal entry point. If the probe yields an immediate profit, it acts as a green light, validating the trader's judgment and indicating that the path of least resistance for the stock is indeed upward. Conversely, if the initial probe almost immediately results in a loss, Livermore's directive was equally clear and non-negotiable. The position must be closed without hesitation. The small, predetermined loss, which should be a fraction of the total intended capital for the trade, must be accepted swiftly and dispassionately. There is no room for hope, regret, or attempts to rationalize holding on to a losing probe. A failing probe is a definitive signal that the analysis was flawed or the timing was incorrect, and remaining in the trade would be an act of stubbornness, not strategy. This immediate cutoff mechanism is a cornerstone of effective risk management, preventing small errors from escalating into significant losses. Only after the initial probe has demonstrated a profit can the trader consider adding to the position, employing the technique of pyramiding. Pyramiding, in Livermore's context, means incrementally increasing the size of a winning position as it continues to move favorably, always adding to strength, never to weakness. This strategy allows a trader to build a substantial position in a stock that is clearly performing well, maximizing potential gains while maintaining a disciplined approach. Critically, each subsequent addition to the position should only be made if the previously added shares are also showing a profit, reinforcing the principle of adding to strength. Beyond the mechanical aspects of entry, Livermore placed immense emphasis on the emotional readiness required for successful trading. He frequently pointed out that trading demands not raw courage, but rather a profound sense of restraint, meticulous precision, unwavering patience, and a long-term perspective. The greatest battle a trader faces is not against the market, but against their own inherent emotions. Hope, fear, greed, and impatience are powerful forces that can distort judgment, lead to impulsive decisions, and ultimately betray even the most intelligent and well-researched trader. A disciplined trader must constantly work to recognize and manage these emotional impulses, preventing them from influencing rational decision-making. This involves adhering strictly to a predefined trading plan, accepting small losses without emotional attachment, and resisting the urge to chase profits or panic sell. Livermore's legacy teaches that true mastery of the markets comes not from predicting every twist and turn, but from mastering oneself, cultivating the mental fortitude to remain objective, disciplined, and emotionally detached from the immediate fluctuations of price. This internal discipline is as crucial as any analytical tool. In summary, Jesse Livermore's 5 steps to an ideal trade entry form a cohesive, disciplined, and time-tested system for navigating the complexities of the financial markets. From the overarching assessment of the general market trend, which provides the essential context for all trading decisions, to the precise identification of leading industries, directing focus towards areas of concentrated strength, each step builds upon the last. The subsequent selection of an individual leader stock within that robust sector ensures that capital is deployed into the most dynamic and high-potential assets available. the critical phase of patiently awaiting a key pivotal point and demanding unequivocal price confirmation before commitment acts as the ultimate filter, safeguarding against premature entries and ensuring alignment with market readiness. Finally, the strategic, gradual entry using a probe and disciplined pyramiding, coupled with an unyielding commitment to emotional readiness, provides a robust framework for managing risk and maximizing profit potential while maintaining psychological equilibrium. These principles are not a magical formula promising instant riches, but rather a systematic, step-by-step approach designed to minimize risk, enhance decision-making, and significantly increase the probability of consistent trading success. By integrating these profound lessons from Jesse Livermore into your own trading practice, you can cultivate the discipline, patience, and analytical rigor necessary to transform your approach to the markets. Embracing these principles means moving beyond speculative guesswork and adopting a professional methodology that has stood the test of time, guiding you towards more stable and ultimately more rewarding trading outcomes. The path to mastery lies in consistent application of these fundamental truths, turning timeless wisdom into tangible results. As we conclude this deep dive into Jesse Livermore's legendary strategies, it's impossible to fully grasp his genius without immersing oneself in the classic narrative that brought his experiences to life. The seminal work, Reminiscences of a Stock Operator, originally penned by Edwin Lefebvre, remains the definitive account of Livermore's trading philosophy and psychological battles. Now, with a newly published edition, this timeless masterpiece offers even deeper insights. This updated version provides unique, expert commentary and detailed breakdowns for each chapter, transforming Livermore's historical experiences into actionable, practical lessons directly applicable to today's volatile markets. It's more than just a historical account. It's a comprehensive guide to mastering market psychology and strategy through the eyes of one of the greatest traders ever. To truly embed Livermore's wisdom into your trading DNA, secure your copy of the new edition of Reminiscences of a Stock Operator today. Find the link in the video description below and begin your journey to trading enlightenment.